How to design your retirement income and overview. In last week's video, I asked everybody what topics you'd like me to talk about, and I got a lot of requests about setting up retirement income and a whole bunch of specifics related to it. And I realized I've done a number of specific articles on specific topics like CPP and OAS, take it early or late, and this GIS strategy and a few things, but I haven't actually talked about like what's the overall, how do you set it up? What's the overall thinking? So this video is just going to be the big picture. There's going to be a lot of the detail missing, but I'm just going to give you the general decisions that are made, but also the thinking into designing it and how do you design the whole retirement income in one shot. So what you will learn today is the big picture of how to design your retirement income. So how do you know when you have reached financial independence? How much can you withdraw from your investments and have them last for your life? How do you design your retirement income? How much do you take from each income source? What are the key concepts to understand about retirement income? What are the 3 retirement income design strategies? How do you decide which one is best for you? And then we'll just do an overview of when to start CPP and OAS and GIS and pensions and RIFs. Should you commute your pension? And we're going to talk a bit about, should you worry about high tax on your estate? How does that fit in? Those are our topics today. Let's start, first of all, about reaching financial independence. So you do that to get there, you need a financial plan first. We have our process we call it interactive financial planning, but basically it's a way you create a financial plan where you can go through many possible scenarios and figure out what is the lifestyle that you want. Like, how much money do you need per year for the lifestyle that you want? And of course, the amount of investments you need to have to do that depends a lot on if you want to retire on 10,000 a year or 10,000 a month or 2,000 a month. Also depends on if you want to retire at 65 or 50. So it's very personalized. You can figure out exactly what's right for you. A financial plan, the goal is to live the life you want and still be reasonably doable. Now, let's say you've got your pension plan and you've saved up your investments. You've got the number that you need, the investments that you need. So you are financially independent. You are now free. You don't have to work. You can choose to retire if you want. So now you want to set up your retirement income. So first of all, you got to decide how much to take out. And so we call that a withdrawal rate. Okay. Now, I've done a few articles on the 4% rule, which assumes it's all about withdrawing 4% of your investments per year and increasing it by inflation. So let's say you have $1 million, that's 40,000 a year you take out, increased by inflation. So what I found is for equity investors, so people investing in the stock market, which are most of our clients, this has been reliable in the last 150 years, based on my study, 97% of the time without managing it, and 100% of the time if you manage it effectively, which we know how to do. So that's a good number. Now, if you're not an equity investor, I have the more accurate rule, which is not a very catchy name, but the actual rule that worked is 2.5% plus 0.2 for every 10% in equities rule. Okay, that's the real one that works. So what that means is if you're a GIC, like fixed income investor, you should only take out 2.5% of your investments a year. You don't have to stick to just principal, but 2.5% of your total investments is all you should take out if you want it to last for your lifetime. If you're a balanced investor, so 50% stocks, 50% bonds, that's so 50% in equities is 5 times 0.2 is 1 plus the 2.5%. 3.5%. So then balanced investors should be using a 3.5% rule. Equity investors can use a 4% rule. Okay. And now this, based on my study, it's been reliable for life. And you want to make sure that it's reliable for life because, once you retire, you want to be completely confident that your money's going to last as long as you do, that it's going to last forever. Okay, so you need that confidence. Last thing you want to do is worry about, I'm 85 and I'm almost out of money. Oh no, what do? I don't want to go back to work. All right, so let's make sure that you have enough. So, and most people underestimate how long they will live. So remember, now if you're a couple, then it's based on, it's not just you, it's you or your spouse, whichever one of you lives the longest. Okay, and also based on survivability tables. So if you're, let's say, 65, you're a couple of average health, the one of you that lives the longest, 50% of couples, one lives to 94. So that's 29 years. And that's a 50% chance of running out of money. So, plan for age 100 is a plan for your money to last much longer. Now, once you start withdrawing, then you're going to need to monitor the withdrawal rate. And we have a whole system for doing this kind of thing. But kind of the big picture of it is your withdrawal rate is going to fluctuate because your investments go up and down. Okay, so you have $1 million, you take 40,000 out. And then what happens is if you have a good year, your investments go up. What happens, your withdrawal rate is a bit lower now. It's 3.8 and 3.6. And in general, most of the years, the market goes up more, and your withdrawal rate tends to kind of decline over time, which means you can start taking more, increasing it by more than inflation. But then you get a down year, all of a sudden your withdrawal rate's 5%, and then you on the same amount of withdrawal because your investments are lower. So you got to start watching it closely. And if it gets up to 6%, then you should be reducing your income. You need to, because it can spiral out of control. So basically it's something to manage. And we know how to manage it effectively. This needs to take into account occasional lump sums. Like, for example, you may occasionally buy a car or take a big trip or something, so you have a regular amount, and then if every few years you take a bigger number out, that's all got to be included in the total. Now, let's talk about designing the actual retirement income. So your goal is to provide the desired cash flow that you're looking for your retirement income, for your desired income, at the minimal lifetime tax, not just this year, but lifetime. So let's decide on the optimal split of how much to take from which income source and when to start them. That's the whole design process. Now, you've got different types of income. There's the fully taxable income, which is, RSP and pension. Also, you might still be working, or you may get rent income, which is also fully taxable. You may have lower tax investments like non-registered investments, which can be pretty low tax if you invest tax efficiently. And the most efficient tax there, based on, I have an article on this, is the the lowest taxed type of investment, non-registered, is investing for deferred capital gains. And then you can have investments that are no tax or even negative tax, such as leverage investments. So, for example, the Smith Manoeuvre, we have clients that are doing Smith Manoeuvre and planning to keep it into retirement as long as they own their home. The actual, tax deductible mortgage gets paid off when you sell your house, not by the investments. So you just kind of keep it forever. And so in most years, so even our clients that have been doing Smith Manoeuvre for quite a few years, the investments have grown a lot and they're retired, trying to take money out. In most years, the tax deduction is still more than the taxable investment income. So it's negative tax, even though they're getting some money out. So that could be quite a tax efficient thing, but you got to be careful not to lose your tax deductibility over time. And then you have the no tax income, which is, mostly the TFSA. Also, some people just have a credit line and you can borrow from a credit line to invest. There's no tax on that either. So those are kind of your different tax rates on different kinds of investments. Now, there's a few key concepts that you need to understand before we get into designing the income. One is there's a difference between income, which is taxable, and cash flow, which is what you need for your lifestyle. So remember, when you're working with a salary, income and cash flow are basically the same thing. It's all taxed, right? But when you're retired, it can be really different because all the different types of investment. I just went through there's high and low tax and negative tax and no tax incomes, types of sources of income. So that's the difference between income versus cash flow. And also, there's the marginal tax brackets. You kind of have to know how that works. In Canada, there's the what happens is you get a basic deduction, like which is like 14,000 tax free, 20,000, let's say, close to it when you're over 65, and then so up to age 50. That's because there's a tax credit. Up to 53,000 each year. This is based on 2023 numbers. Up to 53,000, it's taxed at a 20% rate, and then from 53 up to 102, it's taxed about 30%. Okay, and that's for each person for each year. And then there's a few other brackets, and the highest one is over 235,000, taxed at 54%, more than 50%, which is kind of my pet peeve, but more than 50% tax. So, but okay, so those are the marginal tax brackets. So you want to try to keep, that's marginal tax bracket is what you pay on the next dollar. Okay, so next dollar of taxable income. Now, when you're designing this, you can design your retirement income. For most couples, you can actually live pretty comfortably all at the lowest tax bracket. And so you get 53,000 each. That's 106,000 of taxable income. Plus, you can also have, the no tax or negative tax or low tax income. So we've, got clients living on a retirement cash flow of 150,000 a year, and all of it is at the lowest 20% bracket because each of them have taxable income less than 53. So 53,000. So that's how you can kind of plan it. Plan to split your income and have a certain amount that's taxable and other income that's not, to provide you with the comfortable lifestyle you're looking for. Now, there are 3 overall retirement income design strategies. And so this is the first step to kind of designing what you should do, is you have to think of which strategy you want to do, and they actually determine a lot of the other decisions about when you should start which type of income. Okay, 3 strategies. Number 1, defer tax as long as possible. So the idea here is you pay as little tax as possible now, and that money is, so by not paying tax, that extra money that you've saved can stay invested and can keep growing and can pay for tax later. It's always better to pay tax later. Okay, so with this kind of strategy, you're going to try to withdraw from your TFSA and non-registered investments first, and you may defer RSP, even pensions, other things, because you're trying to, for the first while, you're trying to live on basically no tax for a number of years, and then start paying tax later. Now, when you do this, you may get pushed into a higher tax bracket later because you've kind of depleted all your non-registered investments and your TFSAs. So it might be an issue. The question is, will you get pushed into a higher bracket? And if so, how many years down the road? And you can kind of figure out whether that's optimal or not. Now, usually you don't want to deplete your TFSA and non-registered completely. You want to keep a little bit for lump sums and things. When you're retired, if you're taking regular income, you can make it effective. But then you want to take a one-time big lump sum to buy a car or take one big trip, then you could pay a ton of tax. That can be a higher bracket. So, but overall, this is the deferred tax as long as possible is strategy number 1. From our experience, this is the best strategy. Let's say 20% of the time for 20% of people, something like that. Most of the 20-25%, just based on experience. Now, number 2 strategy is withdraw only in the lowest tax bracket or tax brackets. So this is the idea. Remember, so you try to have all of your income stay at the 20% level. So remember, you can have 106,000 taxable, a couple, only 53 if you're on your own, 53,000 plus non-taxable. So most people can actually retire pretty comfortably, all in the lowest tax bracket. We have some higher income retired people living more comfortably, and then we're trying to stay all in the 20 and 30% bracket. So, but basically that's what you're doing. You're trying to target staying that, and you make sure your income stays below that now, and even all through your life, you plan for it to stay that way. Okay. So with this method, what you're going to do is you're going to withdraw from your pensions and RIF and things like that earlier, and then only take enough TFSA and non-registered if it's above that, or for lump sums. So you're trying to, pay a reasonable amount of tax each year at the low brackets, but not get pushed into the higher tax brackets. Now, this strategy number 2, withdraw in the lowest brackets, is the best option in probably, 70-75% of people. Most commonly, it's the best strategy. And so those are the two main strategies. The third one, I'm just going to mention because it sometimes changes everything, and it's the maximize GIS strategy. Now, I've got some articles out there on the 8-year GIS strategy, and there's also a lifetime version of it. I'm not going to spend much time on it here, but you can get 14,000 tax-free from the government, and if you have zero taxable income other than old age security. Okay, but there's a 50% clawback, so you're actually of your GIS income. That's a guaranteed income supplement. It's part of the old age security program. Okay, there's a 50% clawback on top of income tax, 20% tax. So you're actually in a 70% marginal tax bracket. So if you do this, you can get some free money from the government, but you have to be really careful not to get any taxable income. So it's you need professional advice to be able to do this. And thing is, if you're doing this, you often do things completely the opposite of what you do from one of the other two strategies. Okay, because you need to provide for 8 years or for your lifetime cash flow, all with non-taxed income or with available credit that you borrow to spend, or with offsetting deductions, like, for example, contributing to RSP and deferring and claiming before you retire, deferring the deductions so you can offset things. So bottom line, if the strategy number 3, the maximize GIS income, it can work. It works for, let's say, 5% of people, and it's not only low income people. Or we've had clients making with 2 or 3 million of investments that are able to claim GIS for sometimes for 8 years or sometimes for life. So it's possible to do it, but you got to be able to do this really carefully. So my advice is don't do this without advice. It is kind of really complicated. It's very easy to trigger a bit of investment advice. So for most people, you're going to use one of the first two strategies, which is defer tax as long as possible or withdraw only in the lowest tax bracket. And once you decide on that, it's much clearer about all the other decisions you need to make when you're designing your retirement income. So now, how do you decide which strategy is the best for you? So basically, you're looking at your desired cash flow and versus the taxable and taxable income as separate items. So how do we get the cash flow we want and also have the taxable income be where we want it to be? So now, if you're going to get pushed into higher brackets, you will get pushed into higher brackets if you defer income now. The question is, will you be? And if you will, how soon? So, what you could do then is you work out the way to decide is you work out if the tax saved, assuming it's money that stays invested, if that's what you would do, you just leave it. You have to take less out of your investments. So therefore, that money keeps growing. And if it grew until the time you'd be pushed into the higher tax bracket, would you be ahead or behind? That's kind of the process of thinking. And now, if you're an equity investor, just assume an 8 or 10% rate of return on your investments, and you can kind of figure it out from there. Now, in most cases, for most retirees, when you retire is when you should start your RIF or CPP and OAS and your pension. Start them basically when you retire, or January of the next year. If you're retiring, if you start, in the same year that you retire, then they get taxed on top of your salary income, so you could be in a higher bracket. So you might want to defer them till next year, although you might have to take them because you need to, once you quit your job, you need to have the income come right away. So start it either when you retire or January of the next year is what mostly makes sense, but not always. Okay, so now, when specifically should you start OAS and CPP? So I'm going to talk here about a couple of the specific issues. So here I've written there's a few specific articles that go through this in depth. So I'm just going to give you generally the overview here. CPP, you can start as early as age 60, delay as long as age 70. OAS, you can start at 65 or defer till 70. For both of them, you basically get 7.2% per year more for every year you delay it. Okay, so which is good. Now, the thing is, people sometimes mistake that for a 7.2% rate of return And it's actually not, because you get 7.2% more for life, but then remember, it's certain number of years, and then CPP and OAS end, they're gone at the end. So if you actually work it out to get comparable income, you're making about 5% return on your investment by doing this. And thus, you'll see that in depth in the articles I've written on my blog about this. Okay, so now there's the conventional wisdom. There's a bunch of people that have written articles that when they compare this, what they do is they look at the break even. When have you received the same amount of income from them? So you start your CPP later, but you get more. So how many years till you catch up? And but that's actually the wrong way to think about it, because you're missing the most important factor, which is the rate of return. Okay, so if you got an implied rate of return for this, then instead of that, for example, if you're getting your CPP and OAS, then you can take less out of your investments, and they keep growing, and they provide more later on. And so if you're an equity investor, like most of our clients, you should, over time, you should probably make more than that 5% rate of return. So then you're better off taking your CPP and OAS earlier, and leave money invested, because it should grow faster than the CPP and OAS will grow. So you get higher income that way. If you're more conservative investors, you should probably defer your CPP and OAS, use up your lower return investments first, because you're getting a higher return kind of by taking the CPP and OAS instead. Right? So now RIF. When should you start your RIF? So first of all, what is a RIF? So a RIF, Registered Retirement Income Fund, is the same thing as an RSP, except it's not for saving; it's for taking money out. So when you retire, or whenever you want to start getting your retirement income from your RSP, you convert it to a RIF. And now a RIF, you can't contribute, and you're required to take a minimum out per year. However, it's designed for taking money out, so you can set up an automatic monthly amount that comes to you, and there's usually no fee involved in it. If you take money out of an RSP, you can't do an automatic steady withdrawal, and you have to pay a partial withdrawal $75 fee every transaction. So you want to convert it to a RIF when you retire. And depending on the strategy, you may do it. You could do it later or earlier, but depending which of the strategies you do. But usually that's when you convert it. So that's with the RIF. Now also there's Smith Manoeuvre or leveraged investments. What do you do with those? So there, the most effective is usually to keep keep the credit line or mortgage that's tax deductible keep it tax deductible as long as possible. And the reason is because it's deductible for many years. So if you take too much out of your investments, so if you borrow to invest and you cash in the investments, then the loan becomes non-deductible. And so if you take out part of the investments, then part of the loan becomes non-deductible. And then once it's not deductible, it's never deductible again. You've lost it for the rest of your life. And if you're going to be retired for 30 or 40 years, but you want to it's nice to have that deduction all the way through. So most of the time it makes sense to try to keep that tax deductible forever. However, you may want to choose a bit more, and then it's your mortgage becomes slowly non-deductible over time. So most people with Smith Manoeuvre, they find the most effective thing to do. You're borrowing against your house to invest. The most effective is to keep it for life. And basically, it's paid off whenever you sell your home, not by the investments. That way, the investments are there just to provide for your retirement. Okay, so that's how they can contribute the most to your retirement. Okay, now you are allowed to withdraw from your Smith Manoeuvre investments to pay the interest on the tax deductible mortgage or credit line, and everything stays tax deductible. And you're also allowed to withdraw any income that's taxable. So if you get a dividend, or if you get taxable capital gains, you can, as long as you can trace it that it's from that, you're allowed to take that money out. And everything else still stays tax deductible. So you can take a modest amount of income from them, or cash flow out of them, with basically no tax, probably negative tax, and everything still stays tax deductible. Now, in a fair number of cases, in some cases, you may want to take more than the minimum. So you're taking more than the amount that's allowed. So therefore, your tax deductible mortgage or credit line slowly becomes non-deductible over time. Okay. Now, the thing is, you have to track that. So if you ever reporting to CRA, they will want to know, it's up to you to prove that this is all still tax deductible, or how much of the interest that you're claiming is deductible. And so they don't do the calculation for you. They just, if they're ever auditing you, they require you to prove the number. And if you can't prove it, they just deny the whole thing. So that's kind of the process. So we have a complex spreadsheet we call a Smith-Snyder spreadsheet, where we do the calculations. So where we have clients withdrawing from retirement from their from the Smith Maneuver or their leverage investments after they retire, we have this complicated spreadsheet where we're figuring out, is it still 100% deductible? Or if it's not, then we know how much of it is deductible. And most of the cases, we're still able to keep, 90% deductible for most of their life. So that's pretty good. It's pretty good tax deduction. So that's what you normally want to do with Smith Maneuver. Again, depending on which of your strategies, retirement design strategies you're doing. Now, let's talk about pensions for a minute. So if you get a pension, these usually have two options. One is to defer it, and one is to commute it. So most of the time, what people do is they start it when they retire, start right away. But a lot of pensions allow you to, when you retire, you get some pension options from your pension. Which one should you do? Now, there's two types of pension. There's DB, defined benefit, and DC, defined contribution. And defined contribution ones look like an RSP. Basically, you just have investments and that are in there, and you can pick your investments. So those you can basically, when you retire, you can transfer them with the rest of your RSPs and invest them the same. So I'm talking here about the DB, the defined benefit pensions, which is mostly governments, although a few big companies have them. Not that many anymore. It's declining. But if you have this, when you get this retire, you get this pension options, and often one of the options is to defer and take it. Let's say start at age 65 instead of now. So should you do that? So there's complicated actuarial calculations within a pension, so you don't quite know exactly how it's all done. But we've seen a lot of these calculations and how it works. And also because you think, I get X amount now, or I get a higher amount if I wait until I'm 65 and start the pension then. So is it worthwhile? When we work out that difference, usually it's implied rate of return of about 5% that's built into it. So the general guideline here is, for equity investors, again, if you're in stock market investment, you're probably going to make 8 or 10% per year as a long-term investment, so more than 5. So you should probably start your pension right away and then leave your money invested. If you're a much more conservative investor, then you might be better off deferring your pension and using up your low return investments first. All right, now commuting, should you commute your pension? This can actually be a great way to improve your retirement income. There's some big things you have to know about this. So first of all, depending on the pension, you only might be able to commute if you retire before a certain age or change your job. So for example, teachers, there were so many of them retiring, they reduced it. So you have to be before age 50, which is pretty early, to be able to commute it. And for most government pensions, it's 55. Some allow you to do it anytime, even whenever you retire, you have the option to commute it. So commute means, instead of leaving your money in the pension, you take it out and you control the investment. Okay, so now if you're effective at investing, this can work out really well for you. Plus, you have control of it. Okay. Now, if you have to, some people may not want to retire that early if you got the government pension, but it can also be a motivation to retire, at 49 or 54. So we've helped actually, reasonably number of government employees or teachers retire at 49 and 11 months, or 54 and 11 months, and that's when they retire. And you can work out your plan so it works out, and now you can take this large amount out, and it's larger than you think. Like in most cases, it's just an average government employee. This pension's actually worth $1 million. So you could transfer out, instead of taking the pension, you get $1 million or something that you could transfer out. Now, usually what happens, it transfers into 3 buckets. It transfers into what's called a locked LIF, locked-in retirement account, which you convert to a LIF to take income out. Okay, so a LIRA is like an RSP, except some withdrawal restrictions. And then when you retire, you convert it to a LIF, which is like a RIF, except with some restrictions. However, when you convert it to a LIF, you can unlock half and put it in your regular RIF, so that there's no restrictions on how much you can take out. So so you get quite a bit of flexibility when you transfer it. Now, most of the money goes in there. A chunk of it may not fit on the rules, and it comes to you fully taxable, like as a lump sum, but then you pay tax on it at your marginal tax bracket on that day, on that year. But then it's a non-registered investment after that. Okay, so up until 2021, when interest rates were so low, typically half or more of the total was a taxable amount, because the commuted values were hugely inflated, and it was actually really cool. It actually worked out very, very beneficial to be able to commute your pension then. Now the interest rates are higher. The calculation of the pension, what happens now is the taxable amount is a smaller lump sum, and more of it can go into the RSP, so you pay less tax up front. But there's a higher implied return on it. Now, we got this complicated spreadsheet, quite complex, where we figure this out. So is it beneficial for you to commute your pension or not? And so the way we figure it out is if you commute it, we get the quote, we see exactly how much you get, how much goes RSP, how much is taxable. We work out the tax on all of it, and we figure out if you want to have the same after-tax cash flow for life that your pension gives you, what rate of return do your investments have to make? And that can tell you whether it's beneficial. Now, when commuted values were so inflated up till 2021, the return you needed typically was about 3.5 or 3.5 to 4%, like pretty low. And so there was a huge benefit to commuting in most cases. So now with the rates higher, it's closer to 5.5% that you need to make on the investment. So again, equity investors, if you're making 8 or 10% a year on your investments over the long term, you can commute your pension and get a significantly higher retirement income by commuting it. Now, if you're a more conservative investor, this may not work for you, and then you may be better off just keeping the pension and letting them control the money for you. Now, a few things you have to know about this. So first of all, you have to be comfortable managing, $1 million, a large amount. So usually it's best to get, professional investment management with something like this, because you want to make sure you do it properly. You don't want to worry about losing your investments, and if you invested effectively, it should still be reliable for life. Now, a pension is guaranteed. So remember, effective investments, it'd still be reliable for life. So the pension guarantee may actually not be worth much if you're a good investor, but some people like the feeling of it, knowing that it's guaranteed. And so that is a factor in it. Now, if it's a company pension, not the government, it's guaranteed based on how good that company is. So as some Nortel employees found out, it's the pension's as good as long as the company survives. So, but government pensions, should be guaranteed in that way. So now you get quite a bit when you commute it. So that's one factor. Another thing is you get control of the investments, and it's pretty flexible. So half of the money is put into a locked-in fund where you have a certain range, minimum and maximum that you could take each year, but it's not that big of a range. But half of it you can unlock and you're very flexible. So it's actually overall it's quite flexible that you can take much more or much less of your income, and you have control of it when you have when you commute the pension. So you can, for example, you can choose to take nothing for the first few years and then convert it and then start taking them out, but you decide on the amount. It's not the pension that's deciding. So that can, depending on how you're designing your strategy, your retirement income, that can be that can work effectively for you. You could choose a higher or lower amount than what the pension automatically sends you. So now the other big advantage of commuting is estate planning. So most pensions, if once you're gone, your spouse only gets 60% of the pension. Sometimes it's 80 or 100, but very often, most of the time, they don't get all of it. And then once both of you are gone, there's nothing for your estate or for your kids. So, but if you commuted, it comes all to you. When you're gone, your spouse still has all the investments, and when both of you are gone, all of it goes to your estate. So if you keep the pension, there's nothing for your estate. But if you commute it, there's probably going to be a good amount that's still left over at the end. So now commuting a pension has huge benefits, and it can be really beneficial for the right people. Also has some major drawbacks, and it's not reversible. Once you commute it, it's done. So if you're thinking about this, or it may be good for you, get advice. It's one of those things you shouldn't just do this on your own. You got to make sure you do this right and you think it through properly. So now the other question is, should you worry about tax on your estate? And so I mean, a lot of people really worry about this. Tax on the estate can be a big number. So you're keeping your taxable income all at the 20% bracket throughout your life. And then when you die, it could be taxed at 54%. If you have a big estate, that could be, it could be $1 million of tax. That sounds horrible, right? But let's look at the numbers and see, let's put it in perspective. The other tax is the probate fees. So that's just the investment that can't go based on a beneficiary. You pay probate on it, but it's typically not that high. It's about 1.5%. So depending on the province. So a $1 million estate, it's $15,000. So probate fees is something, but it's usually pretty small. And I've seen people mess up their entire retirement just to avoid a little bit of a probate fee. So now, just so you understand, tax on your estate, we do not actually have estate tax in Canada. In the US, they have it, but it's basically on really large estates. So here, what happens is it's only income tax, and it's assumed that all your investments, everything you own, is sold when you die. Now, if you have a spouse, it could all transfer tax-free to your spouse, but when the second one of you is gone, it's deemed that all of it's cashed in. So that means all your RSPs RIF that you have, it's deemed that they're all withdrawn, and the full balance is taxable in that year. Also, any non-registered investments or any other investments that you have, Smith Manoeuvre investments, it's deemed that they're all sold, so you'll have a capital gain probably. And if you've been investing tax efficiently, you may only have taken so much off, and you were investing for deferred capital gains. Let the investments grow and grow and grow for many years, so you're not paying much tax. That's how you pay negative tax on your Smith Manoeuvre for your life. But then it could be a big capital gain when you die. Same thing if you have a rental property or something. You're getting a rent, but then there could be a big capital gain when you die. So all that could be a pretty big amount. And if the total tax amount is over 235,000 plus any regular income you had in that year, the amount above that's all taxed at 54%. So can be a huge number. So, but the truth is, it can be less than you think, less of an issue than you think. Even paying $1 million in tax may be less of an issue than you think, because let's just figure out the effect of it. The thing is that it's many years off in the future. With in all likelihood, it's way down the road, and therefore, thing is, let's say you can do something now to pay less tax, so that I can pay more tax today, so that I pay less at 54% when I retire. Am I better off doing that? So if you're on the 20% bracket, you might be able to pay it all at the 20% bracket. If you're, a little bit higher than 30%, like if you take more out of your income now, pay 30% tax on it, and then remember, 20% goes up to 53,000 of income, taxable income per year. 30% goes up to 102. So per year, and for a couple, it's double that number. So you could take a higher amount out, so you have less of a gain later on. But you're paying tax now, more tax now. So now, if you do the math on it, so let's take the math for equity investors, which is most of what our clients are. Let's just say your investments, by not paying that tax, your investments stay to grow, and they grow by, let's say 8% a year. Now, 20% tax, by not paying the 20% tax now, that amount would grow to more than 54% tax in 13 years. And if it's 30%, if you have to pay tax at 30% tax now to avoid the 54%, it would grow to more than that in 8 years. Okay, so the idea here is it's only worth doing if you're within 8 or say 13 years of dying, and that's when you and your spouse will both be gone. Okay. Now, again, remember, most people underestimate their life expectancy. If you're a couple with average health, the one of you that lives the longest lives to 94. And once you get your 80s, the one that you've the longest is basically living to 100. So bottom line is, you probably shouldn't worry about this until you get over 80 or possibly over 85, unless you have significant health problems and you realize that both you and your spouse are not going to live that long. Then it can be something when you think you're within the last 10 or 15 years of life for both of you, that you can start thinking about doing this. But generally, it's not worth thinking about earlier than that. All right, so those are that's the basic design of the whole thing. And we talked just a general overview about a few of the retirement planning issues or retirement income design strategies, or issues. So now, just a quick summary. The way you do this, you become, you from a financial plan tells you that you're financially independent. You look at the 3 retirement income design strategies, and you pick the one that's the best for you. Okay. Then you design your retirement income by choosing how much out of which income source, how much from which one to get to the total that you want, and also when you start them all. And of course, the 3 underlying design strategies are the main determinant of which one you should start when. And so you're taking the whole income that you want, you take how much out of, you have all these different sources, and you try to get it to the desired retirement lifestyle you want at the lowest lifetime tax. So it's a matter of getting the right balance between deferring tax and keeping your marginal tax bracket low. Find the best way to provide the cash flow for your desired lifestyle with the optimal taxable income. So that's what we're kind of doing this whole process. And once you've kind of figured out the overall picture, then you can look at specific issues. What about CPP? What about my pension? And look at them specifically. And we get specific articles that go much more in depth than this video does. But I'm here that we're trying to give you the overall picture of how to design your retirement income. And just the thinking behind it and all that. All right, so that's my topic for today. Thanks a lot for listening. Again, my name is Ed Rempel. My blog is Unconventional Wisdom. It's edrempel.com. And my blog is #1 in Canada for a full-service financial planner. So I try to do a video or article every week. So I've got my blog and I got my YouTube channel. I'm also on social media, so you can, if you partner up on social media, you'll see all my notices. But basically, if you subscribe to my blog and my YouTube channel, what'll happen? We don't market to anybody at all. All that happens then is you will get my new articles or videos sent directly to your email each week. I try to do one article or video every Thursday, and it's unconventional wisdom based on all my experience. So you can read and listen to everything else that's out there and your other advisors and all that, get the conventional wisdom, then come to my blog or a YouTube channel and find out what actually works in practice. So if you are interested in potentially talking to us, go to my blog. There's the contact button, and you can request a free 30-minute consultation, and that's just about finding out what you're looking for, what we do, and we can decide together whether or not we're a fit to work together. So okay, thanks a lot for listening, and we'll talk to you next week.